They said it could never happen, that the United States, the world's largest economy, the so-called safe haven of global finance, would always have perfect credit. But today, that belief is beginning to crack. The whispers have turned into headlines. After decades of being seen as the gold standard, the US is now facing the very real possibility of losing its AAA credit rating. And if you think that won't affect you directly, think again. Welcome back to the Money Blueprint, where we decode complex financial events and turn them into smart, actionable strategies. Because your money deserves more than fear or hype. It deserves clarity. When a country gets downgraded, it's a signal to investors worldwide that lending to that government is becoming riskier. And when that government is $34 trillion in debt, the consequences can be massive. When trust dips, borrowing becomes more expensive. The US government issues bonds to raise money, and those bonds are considered risk-free, at least for now. But if Moody's or another major agency downgrades America's credit, the interest the government has to pay on those bonds goes up. Trillions of dollars in debt suddenly become even more expensive to manage. And that burden? It doesn't just fall on Washington. It trickles down into taxes, inflation, and the shrinking value of your dollar. But that's just the first domino, because when US bonds wobble, the entire market feels it. Investors may pull money out of stocks and rush to safer assets. Ironically, sometimes even back into short-term bonds. Volatility spikes, equity markets jitter, and if you've got money in the market, your portfolio takes a hit, even if you've never bought a bond in your life. And while this is happening at home globally, a bigger shift begins. Countries like China, India, and Russia, already exploring alternatives to the dollar, start to lean harder into their de-dollarization efforts. When the world's reserve currency shows signs of instability, it doesn't go unnoticed. If the US becomes less dependable, the global financial center might start slowly shifting, an idea that would have seemed unthinkable just 10 years ago. But let's bring it back to you, because while the headlines focus on debt ceilings and downgrades, you're probably asking one thing: what should I do now? This is the moment where reactive investors panic, but proactive investors prepare. Understanding how credit ratings affect inflation, interest rates, and the stock market gives you an edge. It means you're not just following the news, you're positioning yourself ahead of it. And that's what we're here for. At the Money Blueprint, we believe that financial intelligence isn't about reacting to chaos. It's about spotting patterns, asking smarter questions, and always staying 2 steps ahead. So if you're someone who doesn't just want to know what's happening, but why it matters and how to respond, then hit that subscribe button, because here we don't just talk about money, we build the blueprint for it. Thanks for watching. This is the Money Blueprint, and this is how smart money thinks.